Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Metropolis Health, which is trading at only 7,000 crore as a market cap. Let's understand what is the business and whether you should get into the stock or not. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research, and I am not in favor or against any company that I talk about. Before I talk about Metro Healthcare, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel and it will help you also ask me questions on a detailed basis. The Patreon membership begins with $2 a month, and on $10 a month, you get access to my portfolio, my watch list, and you can ask me questions on a daily basis on stocks, on markets, and trends. For a detailed analysis of a number of stocks that you have, you can directly email me and we can work things out. Now about Metropollis Healthcare. Established in 2006, they provide medical testing services, one of the fastest growing lab brands. So we know that currently there are a couple of labs that are the leaders here in India, but Metropolis is also growing in stature. 4,500 employees and 125 centers. It's expanding every day, expanding every quarter, and trying to scale new highs with respect to expansion of the number of you can say centers that they open up, present across India and 7 other countries. So it is present say globally as well in 7 countries outside India, and it will benefit with the lifestyle change that we are seeing. And they are also getting a number of orders with respect to testing for the current pandemic and for other tests as well. The market cap of the company is around 7,000 crores. If you look at the numbers, then it is not that it has just catapulted in terms of numbers, but the sales have improved by around 2%, although the profit has dipped by around 60%, and this was due to one-offs as well, and due to higher expenses beared by the company in this March quarter. Absolutely zero debt company, and a very good dividend payout. And what is extremely good about the company is the return ratios. The return on equity of 28% is absolutely tremendous, and operating profit margin of 27% up till March is also above average when you consider industry average or even averages for consumer domain stocks. So this looks extremely good. If you look at the financials of the company, the stock has doubled, or not the financials but the performance of the stock, then the stock has doubled over the last 12 months. There have been a sharp decline seen in March where the stock fell 35-40%. It is consolidating at the moment, and doing a great job, neither falling nor going up. Results have remained robust apart from the last quarter, in which we have seen a sharp drop in profitability. Otherwise, results and operationally, the company has done extremely well. There's strong promoter and institutional holding, and there's only 3% free float in the stock. So 97% of the stocks are with the larger players, are with either HNIs, FIIs, DIIs, or the promoters, and this augurs well for the stock. When numbers really kick in big time, then the stock would be as it is with strong hands. So the stock will not fall that much, and there'll be higher demand, and the prices will go up even further. Absolutely no debt, and as I mentioned, high return ratios. Now the issue with the stock is, and this is what I have come up with after a lot of research, is that 34% pledging of shares, but the pledging of shares was around 45-50% 2-3 quarters back. So the pledges are coming down, but this is a real deterrent as far as I am concerned. I normally avoid all stocks that are having at least 10% or more pledging in it, 5 to 8% or more than that, and higher debt. So 34% pledging is not quite what I was looking forward to, and probably this is the reason why it has not catapulted to the same level as the other two diagnostic companies that are listed, although it is also trading at expensive valuations. If you look at the technicals of the stock, then there's strong support around the 1400 levels. Looks like it is about to break out. So and it is currently on a big breakout. On a long-term chart, it should continue to make new highs that it is trying to make. Breakout is expected above 1520, 1550, which is now it is trying to just take over. So buy above 1520, 1550, and can be accumulated in this 1300, 1400 zones. That would be good, but be very wary of the fact that it is having pledging, wary of the fact that the March quarter has not been that good. So probably other diagnostic companies could be a better bet to look forward to or go forward to. Another thing I want to point out here is that currently the sentiment is with the diagnostics and hospitals, and you can say the pharma stocks. Maybe 2 3 years down the line, it would not be the same, and hence there could be a situation that people would shift to other industries going forward. And hence I believe that probably if you have a 2 year time horizon and you're looking for 40 50% upside, then you can get into these spaces. Otherwise, on a long term basis, 4 to 6 to 7 years, I think pure consumption plays would always tend to do better. So kindly take that into consideration. That these are my opinions. You can make up your own mind as to how to go about it, but yes, for the next couple of years I do see diagnostics, testing, and you can say medicine companies, or pure pharmaceutical companies. Some of them I have mentioned on a number of occasions. These companies might be doing well for the next 7 8 quarters, but after that I think the pure consumption theme, FMCG theme, consumer durable theme will again come back into fashion, and they will continue to do well for the next 2 years, and then probably 5 6 years even after that. It would be a boom once this pandemic ends. At most, I believe that it would take around 1 1.5 years for everything to settle down, with everybody getting the vaccine and things getting normalized, probably 18 months at max. And after that you will see, so 6 more quarters, and after 6 quarters, all these consumer durable and consumer discretionary stocks doing well. So what needs to be done? Can be bought on major declines, and as I said, will be in focus as people's habits change, and probably in the next 2 years, these stocks would continue to do well and continue to command a higher premium. Market cap of only 7,000 crore is small in my understanding, with the kind of business that it is having. Look for massive market declines to buy into the stock, and have less than 5% exposure to the stock. If you are uncomfortable with the kind of pledging that it is having, you can avoid the stock as well. There are many other companies that you can invest into. So this was my video on Metropolis Healthcare. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.